ultimately the printing press always wins in the end. And that is bullish for commodities. So I do think that we are due for a commodities supercycle move. And I do think that it's fundamentally related to the broader trends globally, not just in the United States. All roads ultimately lead towards more money printing, more inflation. That's good for anything real, including real money, real estate, real commodities.
Lobo Tiggre, seasoned financial analyst, as well as founder of the Independent Speculator. It's a true pleasure to host you on Palisades Gold Radio.
Happy to be back on the show.
Excellent.
But
really
you left out my title of official rain on the parade. And with the parade in gold and silver screaming down the road, this is a good time to talk to me.
Yeah, it's definitely an exciting time to talk to you, Lobo. The commodity complex as a whole seems to be taking off. There might be some value to be found still, but before that, I would love to talk about gold for a second. I'm trying to, and I'm sure viewers at home are trying to wrap their minds around really what is happening to that yellow metal currently.
Well, what can I say that's new? We all know about the central banks. That is a game changer. I'm not dismissing that. It's important. I think what is new, and I've had this sense before, but I'm hearing it from other people like Rick Rule too, is if you remember, if you've interviewed Rick before, you may recall that he likes to say that the global average allocation to gold historically over the decades is 2%. And until recently, it was 0.5%. Therefore, there was a potential of 4 times of investment demand, not necessarily the gold price going 4x, but the investment demand going 4x, if the demand simply reverted to its historic mean. So he's been saying this for quite a few years. I believe we're starting to see that happen now. And anecdotally, you can see it like the talking heads on financial media before, they couldn't even spell gold, even though it's only 4-letter word. Now they're bringing up all the time, oh yeah, we're doing this, that, and the other, NVIDIA, Taco Bell, whatever, and we're hedging with a bit of gold, right? It's just there where it wasn't before. And now the interviewers are asking, somebody says, oh, I'm doing this, that, and the other, NVIDIA, OpenAI, and they're like, well, what about gold? I've even heard an interviewer do it twice. Well, gold, we like bonds. Well, but isn't it a safe? Like they're starting to really push this point now, which they didn't do before. It's quite interesting. That's anecdotal. We won't know until in hindsight. But we also have reports from people who manage money and the influx of questions. So I think this is a big deal because the central banks, one, they don't have a calendar. It's not like they buy the same amounts every month. I mean, it's great that they're there. And I think that's a really durable source of demand because it doesn't go away, right? They may reach a full allocation at some point, but asking when will central banks stop buying is kind of like asking when will central banks stop printing. It's not going to happen, right? And if, the move away from the dollar, even if the dollar will still be the principal reserve currency of the world for many years to come, that move is also happening. And, even if Trump is replaced in a couple of years by somebody who's totally pro-China, China's not going to go back to wanting the United States to control its financial lifeblood. So I think this is a one-way thing, but it's not something you can count on every month. And it's also starting to be priced in. This other thing that I'm saying is new. This is the unknown that is still yet to be revealed and measured. So that hasn't been priced in. If I'm right, there's still a lot of upside left here, but let me get back to the rain on the parade moment, because the way I've answered your question, it sounds like I'm saying, yeah, it's going to the moon, 5,000, 10,000. And it might. I have written, actually, that reaching 4,000 might be the very thing that does take it to 5,000 and beyond, because it creates this pile-on mentality. But it could also trigger profit taking. Now, today, as you and I are recording, it's gone on to 4,100, doesn't seem to be looking back, so I don't feel too nervous talking about gold maybe moving higher. And let me be clear here, though. At some point, there's got to be a correction. Nothing goes straight up forever. Even when you look back in history, 1980, 1979, it looks like it went straight up. If you zoom in, it doesn't go straight up every day. So And there was, of course, that massive 50% correction in the middle of the great 1970s bull run. So I want to be very careful with what I'm saying. I'm very bullish. The arguments, the reasons why gold can continue going higher are very compelling, very strong. But I also remember arguments like that in 2011 after the GFC, very compelling arguments for why gold needed to go up. So I'm not saying to sell. I'm not turning into a bear. I have a strategy I call upside maximizer, which is sort of like trailing stops, but not stop losses. I put them on my big wins to prevent them from, slipping through my claws. So that's what I'm saying. I'm not saying get out. I'm not saying sell. I'm not calling a market top. I'm saying I don't know when that's going to happen, but there's going to be a correction at some point, and I don't want my big wins slipping through my claws, and I wouldn't want them slipping through your fingers either. So whether you use my upside maximizer strategy or have some strategy of your own, don't forget that nobody goes broke taking profits.
Great nuanced point, Lobo, and that's exactly why we enjoy listening to you, of course. Talking about this historical parallels, you mentioned the 1970s. Of course, when one looks at that time, government debts were lower. The US dollar was at its peak dominance back then. Quantitative easing, QE, wasn't really invented yet until the 2000s. Is that even a fair parallel to make? And therefore, shouldn't this time be a bit different in the sense that this bull market might look a bit different?
Yeah, you did say this time's different. Yes, no, that is fair. I think the big one actually is that all those things are true. There are some parallels, though, with, OPEC and oil. And okay, oil is down now, but, they're still there, and they're still, The big one, though, is that until 1971, the dollar was defined in terms of gold. You as an individual couldn't redeem, but countries could and did. And so there was very much a coiled spring effect. The United States government had defined, we call it a peg, or the price of gold was set. That's not right. It's really the other way around. It was the dollar that was defined, a certain amount of gold, which everybody knew wasn't true. And that's why de Gaulle was got his fingers caught in the gold window when Tricky Dick Nixon slammed it shut. So that, to me, is the biggest change. There's a huge change of it being set. The price was not free. It was set. And then after that, it was free. And of course, this coiled spring let loose, and it went roaring higher. So that's completely different this time. We're not coming off a price control. People might say it's manipulated. Okay, but the price wasn't set. It pegged at a certain level. So that's very different. I get that. On the other hand, there were arguments in 2011, for example, that, we're just as strong. This time is different. We've never had anything like this GFC. And really smart, normally cautious people were saying, this is it. There's no way they can paper this over. They can't kick the can down the road anymore. The dollar's going to its intrinsic value, as my friend Doug Casey liked to say, meaning zero, right? And it didn't happen. Right? Very smart people made very convincing arguments for why gold had to go to the moon 14 years ago, and instead it went into a bear market for 5 years. So this is just a fact, and I'm not, well, I guess maybe I am trying to rain on the parade a little bit. It's much better to have steady progress than to go totally parabolic, because that's just not sustainable. Nothing can go straight up forever. I'd rather see gold correct, consolidate, move forward, even 2 steps forward, 1 step back, would give me more confidence in the longevity of the market than just, screeching higher and faster. And by the way, I know we're going to switch into silver. So, the fact that silver is starting to catch up is actually pretty scary to me, because even your most diehard silver bulls will tell you that silver usually lags gold in a bull market and then more than catches up in the end. Actually, not just usually. It's done it every single time except for 2020. So if silver's starting to catch up to gold, that's actually a signal. I'm not calling the market top, but it is a signal that the market top could be nigh. Now, nigh meaning what? Meaning 2x from here? Who knows? But the answer to your question is, yeah, history doesn't repeat, but it can rhyme. It is... the rain on the parade here is not that I'm turning bearish, but just don't let it go to your heads, dear audience. Don't say it can't correct or it has to go to the moon from here. It might. Great. We're all long. Fantastic. But don't let those gains slip through your fingers.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. Thank you again, Lobo, for that nuanced take. Perhaps something we can talk about is this bull market, and you referenced, of course, the 1970s a couple of times. That was a 10-year affair. If you were to define this one as starting in 2022, this might be a 3-year affair, depending on your starting point, of course. And we might still have some ways to go. Of course, you also talked about silver. Silver is definitely has
Sorry,
its...
Stijn, let me jump in on that. You could do that, but why 2020? Just because it's convenient? Really, when did... If we're going to compare to the 1970s, you go from long-term price control base, and then you have this big surge up to the mid-70s, 50% retracement, and then you screaming up to the blow-off top in 1980. If that's the comparable, really the most reasonable basis would be to go back to 2000, 2001, where you had a long, low base. It goes, finally, it cuts loose, and then you have this correction, from intraday high of 1911 per ounce of gold in 2011, all the way down to close to 1,100. It's about a 50% retracement. So if that's the first bump, like 1970s, well, then we're now in that screaming up towards the end of the market now. So I would actually caution against it. Like, if you want to believe that on the fundamentals, all the money printing, the central bank buying, what I've started out with portfolios reallocating into gold. If you want to make a fundamental case for why gold needs to keep going higher for years, you don't want to make the argument that this is like the 1970s. Because if it is, I think that the argument would be we're in the second half, right? The cup and handle, now we're in the blow off top. I don't want to make that case.
All right. Point well taken, definitely. For a generalist investor that might be watching this that doesn't really have an allocation to gold, do you think it is too late to step into this bull market?
Well, let me separate out bullion from the stocks. Bullion, I don't buy it as a speculation because I think the prices are going higher. I don't even consider it an investment. I consider it insurance, right? It is that financial asset that you can own, you can be long, for which there is no counterparty short, and it's fire insurance in case of need. And I have personally experienced this in my life, where my coin collection helped me when everything else failed. So that's how I see it. In that case, you really don't ask how expensive is fire insurance. What you do is you ask how many sparks and how much tinder is there around. And if the world looks perfectly safe, not much chance of fire, then maybe you don't need any fire insurance. If the world looks dangerous, there's wars, there's trade wars, right? There's all, commodity wars, there's all stuff going on, fiscal profligacy. I'm seeing a lot of smoke, tinder, sparks all around. In that environment, I think if I didn't have any insurance, I would want some. And I wouldn't worry about, am I top ticking this? Is it expensive now? I would want to know that at least I have some, because if there is a fire, it doesn't matter what the insurance cost you. You're so glad to have it. Right? So that's the bullion. And by the way, the same applies to silver. As far as the stocks, I can tell you, I for the first time ever, I have pulled my shopping list. I have no shopping list this month because I just couldn't bring myself to encourage anybody to buy when it's just pulled a hockey stick. I'm the buy the dip guy. I'm not the chase the FOMO guy. That said, and some people say, oh, well, there's this overlooked gem over here. It's really cheap. Sorry, No, unless you've really smarter than all of the rest of the brains of the market combined, that's probably not an overlooked gem. There's probably something wrong with that stock because the market is telling you that it doesn't deserve to go up with gold, right? So I'm not saying it's too late to make money in this market. I'm saying I'm not buying anything right now in gold or silver right now. There's always a market fluctuation, and I would look for that. And if it doesn't happen, there's always the next thing to rotate into. I'm looking very strongly at copper right now. I've been accumulating money specifically to put into copper, and if I do end up taking profits in a fluctuation in gold and silver, then copper is the main destination that I expect to put that into, because I see a very durable bull market in copper ahead. Like what we've experienced now this year is just, it's not even the beginning of that. It's other noise, Trump stuff and whatnot. So, I don't chase momentum. I'm not saying it can't go higher, but if I did say, yeah, don't worry, just buy now, and gold drops, just say gold corrects, right? An official bear market defined as a 20% retreat. 20% retreat from where we are now is still over $3,000 gold. I mean, that's still a fantastic price for the actual business of mining the stuff. But if gold retreats 20% from here, those stocks are going to fall off cliffs, which I think would be an absolute gift. That's if I was looking to go long here, I would, and I didn't own any right now, I would not jump on that bandwagon. I would look for a buying opportunity. And if that meant I missed it, it's okay. You can't kiss all the girls, like Doug Casey likes to say. And there's always another one to ask out to dance, be it copper, maybe uranium. By the way, uranium corrected last week. And the bull story in uranium is so strong, the stocks didn't correct much, but the spot did. If that continues, instead of worrying, is it too late to buy gold or silver? Well, why worry about that at all? Why not look at other things that are on sale? So that's what I'm saying. It's better to rotate than to chase momentum.
I recently had a chat with Matt Smith, who I believe coined a quote from Doug Casey. This might just be the last gold bull market, was the thesis. What is your general response to that?
Well, who knows? If back in my Casey days, back in the global financial crisis, and we thought this was it, there's no way they could paper this over. Doug used to like to say, the dollar is going to its intrinsic value, and there's going to be riots, and I don't want to see it out my front window. I want to see it on my big screen TV in Argentina or Uruguay, where he is now, that sort of thing. Well, flash forward, and at that time, gold came off a bottom of $700 in 2008. We thought that $1,000 gold would be a great price, $1,500, and we'd be woohoo, champagne all the way to the bank, right? So, and if it ever got to $4,000 or $5,000, that would mean there would be riots in the street and wars going on around the world and all kinds of chaos. And, if you look around the world today, Doug's in Argentina or Uruguay watching this on his big screen TV. We've got $4,000 gold. Looks like it wants to go to $5,000. We've got wars. We've got chaos. We've got change. It's you could make an argument that we're there, but who knows? If there's one thing I've learned in my career is that nobody knows. Even the best and the brightest, the smartest, most disciplined people, the ones I respect the most. Even your Rick Brule, if you've seen his latest interviews, he's been doing some selling. I'm not selling yet. I've got my upside maximizer triggers, and I'm waiting for that rollover to trigger, and then I'll lock in some of my gains. But he's not waiting for that. He's selling already. He's made a bunch of money, and he's saying he's sailing for the point of no concern. So, just beware of narrative, right? We all like to talk about, don't drink the Kool-Aid and the mainstream narrative, but we all gold bugs, we have our own narratives, right? And we might be right. Gold might go to 5,000, 10,000, but it might not. And if it does, I'd rather see it through my big screen TV than out my front window. I can tell you that.
All Right, so on the gold miners front, really just holding your position, not really adding right now. If there's correction, you might add to your positions right now. So the argument that a lot of people are making is that these gold miners are still very attractive on a price to cash flow ratio. That doesn't fly for Lobo Tiggre?
It's fair. Well, not even that, but if you look at them priced in gold, which, okay, if you know, it bothers me when people want to price Bitcoin in gold or pork bellies in gold. Like the world, I think gold is real money, but the world at large doesn't. So it's not really, I think, methodologically sound to try to go around pricing everything in gold, because that's just not the way the market today works and not the way the market analyzes it. But when it comes to gold companies, it actually does make sense to price them in gold because that's what they produce. So it's another way of just talking about their margins, right? And so if you look at gold companies priced in gold, then yeah, I think there's a legitimate case to be said that they're still good values. My problems with that is that, okay, that makes sense to me logically, but it's still not the way the market works. If you're the generalist investor out there and you're saying, oh, maybe I should think about gold stocks, you're going to look at the nominal chart and you're going to see hockey sticks, and you're going to, if you're not prone to FOMO, you're going to say, wait a minute, I don't know, do I really want to be buying all-time highs? That's, I think, the way most investors are going to look at that. So yeah, we can make this argument, but I don't know that that's going to drive the market. The other thing is, I just said that, even if gold, let's say gold corrects $1,000, right? We're still over $3,000. And these mines were built on gold price assumptions of like 1,300, 1,400 for the better ones, 15, 16, 1,700 for others. Not so long ago, $2,000 was considered an aggressive gold price assumption. And now, like, it could correct $1,000 and we'd still be 50% higher than that. Like, so that's an insane margin that these guys, they can like literally print money right now. But what happens next? Costs catch up. In a world where gold keeps screaming north, what is gold telling us? Like, why is this happening? It's not just in a vacuum, oh, yeah, gold's going up. It's going up for reasons. And this is what always happens when the monetary metals go screaming north faster than costs, your margins expand and you get the stock surging. That's great. Even generalist investors get that. It's margin expansion, that's normal. It's not just gold bug jargon, that's normal. Everybody sees that, right? But then costs start catching up. And, so what I've told my readers is, let's look, I'm a speculator, but I'm not a gambler. By speculation, I have a discipline. I have a method that Rick and Doug and others have taught me, and I'm very rigorous about keeping my risks to a minimum. As a disciplined speculator, I completely yank my gold stock shopping list. I'm not buying anything. If I was a gambler, however, or a day trader, maybe I'm repeating myself, but anyway, or let's say I had some money and I was going to go to Vegas and I was going to have a shot at the craps tables, the roulette. Well, instead of doing that, then I might bet on gold stocks, right? It's if I'm interested in the casino, like I said, if the fact that gold hit 4,000 is what takes it to 5,000, those all-time highs in gold stocks could easily be doubled. There's your clickbait headline if you want, Stijn. Lobo Tiggre says all-time highs could double. Well, yeah, anything could happen. All that I'm saying is we don't know where the top is, right? And if it's ahead of us, if silver is catching up to gold now, and that means the blow-off top is in front of us, well, that implicitly means everything's going higher from here until it doesn't. So if I was a gambler, if I thought it would be fun to go put money in a slot machine and pull the handle, screw that. I'd rather bet on even the majors, even the all-time high, best of the best, and would actually be the starting place. Some crappy little fly-by-night junior, that's not where the money's going to go pour in. When the FOMO really kicks in, and I'm seeing CNBC talking about silver going to $100, this stuff is starting to get scary in terms of the mainstream jumping on. Those people who've never heard of gold stocks or silver stocks don't know what Franco-Nevada or Pan American is, or whatever. Pick your blue chip, not just necessarily those, right? They start looking, what is a gold stock? What's the biggest gold company in the world? That's where the late money is going to go. So if we're at that blow-off top stage, which I sincerely hope we're not, but if that's where we are, And what happens next is a truly ridiculous, ludicrous mode jump vertical from here. Ironically, the biggest and slowest moving companies in our space are likely to be the ones that get that rush of dollars initially.
Thank you, Lobo. Talking about silver for a second, you recently tweeted that the spot price of silver is rising above the futures price. Why is that interesting, and what is it telling us?
Good news and bad news there. So, it is unusual. Backwardation like that is unusual. And in this case, I don't think it's telling, like a lot of people are jumping on the silver bandwagon. Woohoo, yeah, this is it. We're off to the race. Silver's time has come. The long scheme of silver suppression, the most manipulated metal in the world, it's finally coming to an end, and the shorts are being forced to eat their shorts. Yeah, woohoo. I'm not sure all that's true. What we had was when the Trump tariffs were announced, we had this huge rush of metals into the United States. There were a lot of reports about this from multiple sources. This isn't gold bug conspiracy theory stuff. Like, a lot of London gold and silver got shipped to the United States. And right now, there's a short, there's a squeeze in London on silver specifically. And so that's what's, and so if you've got COMEX silver futures in the US, and you've got London silver bullion related to the spot price, then it's not surprising that in a squeeze environment that exists in London but not in the US, that it would influence the spot price more than the futures price. So I think that's really interesting, and it's real. So that's really neat, and it's already exciting. Like the last time silver hit $50, it's an intraday high, and it goes right screaming back down, just went vertical and right back off the cliff. Now we're looking at, several days, including a weekend. Okay, that's cheating, but we've got 3 days plus now of silver plus $50. That is different from last time. And so the good news is that this squeeze in London will take a while to resolve itself. And that makes this durable enough to get really people thinking about silver who might not otherwise have. That's really interesting. On the other hand, silver is being mined, right? There's an open question as to how much time it will take that market to rebalance. So, other things being equal, I don't actually think this will last that long. The squeeze is there. That same silver that flew to Chicago can fly back to London or New York, right? It can fly back, and I understand that is happening. But that still leaves a question: will it be enough? Because now we also have silver is at long last recognized as a critical mineral by the Trump administration. So what if the U.S. doesn't want to let go of its silver stockpiles? Just today, Trump announced a $1 billion critical minerals stockpile. And by the way, according to Trump, critical minerals includes uranium, gold, and silver, not just copper and neodymium or whatever. So interesting times. As I was starting to say, other things being equal, I would expect the squeeze in London not to last. But other things aren't equal. And in today's world of increasing resource nationalism and competition for securing critical minerals, this could take longer to rebalance than one might think. If so, that would be really interesting. I don't want to make any more forward-looking statements after that. But if remember that silver is produced as a byproduct, and most of it from these big porphyry mines. There's not a pure silver miner up there who can say, oh yeah, $50 silver, I'm going to ramp up production. There's a few smaller, mostly silver ones that can ramp up a bit, but even that takes time, and there's not many of them. They're not market movers. I'm not personally piling into silver stocks right now. But there's potential here for near-term explosive potential in silver that we've not yet realized. So I'm trying to, maybe the audience gets mad at me saying, well, gee, Lobo, you're not helping much. You're saying maybe yes, maybe no. Well, would you like it better if I said definitely yes, but then was wrong?
Well understood, Lobo. I really appreciate you taking us along there. I'm going to be pulling up a chart real quick for a second. This chart's really plotting the gold price compared to the commodity complex as a whole on an equal weighted basis. And it's showing that gold normally moves first, the commodity complex follows. Is there a catch-up trade here that one might be looking at?
I think so. These charts can be very noisy. I wouldn't put too much weight on this alligator jaw has to close in such a time or way. I'm a fundamentalist, ultimately, not a technical analyst. And despite the central bank buying and the portfolio rebalancing and the wars and the fears in the world. Oh, by the way, gold just kept going north, even though we have what looks like peace breaking out in the Middle East. Maybe the beginning of that. Just a thought there. There were people who were afraid that peace breaking out would be the end of the gold rally. Well, not today's erg. But anyway, the bigger picture here is that all paths lead to inflation. The U.S. agenda, and this is neither praise nor criticism of the current administration, love Trump or hate him, doesn't matter. His agenda, the transformation he's attempting to bring to the United States is highly inflationary. And, all these hopes that, Doge is going to cut $2 trillion, it didn't happen, right? So, the U.S. is on a highly inflationary path. Europe, rearming is highly inflationary. Russia's war is inflationary there. The only real sort of hot spot of deflation in Asia, I think, is an artifact of the trade war. And just today, as you and I speak, we saw reports that China is finding markets for its goods other than the United States. Like its exports just went up like 2x over what was expected, not to the United States, but to other places. So I'm not worried about durable deflation in China. Ultimately, the printing press always wins in the end. And that is bullish for commodities. So I do think that we are due for a commodities supercycle move. And I do think that it's fundamentally related to the broader trends globally, not just in the United States. All roads ultimately lead towards more money printing, more inflation. That's good for anything real, including real money, real estate, real commodities.
Well understood. I would love to dive into copper for a second. You mentioned you're a fundamentalist. I would love to hear the fundamentals behind your copper thesis.
So briefly, that would be a repeat of what I just said. If you knew nothing else about copper than just the inflationary trends in the world, Dr. Copper would diagnose that, I think, quite accurately. On top of that, though, you could say the same thing about oil, right? It's a fundamental, essential industrial input. So oil also is highly economically sensitive. The difference, though, and the similarity is also with the electrification of the world. People are calling copper the new oil, right? Then it's not. But there is a reason to tie these two similarities here. The difference, though, is that you've got, OPEC flooding the world right now, like vastly increasing their rates of returning to as much pumping as they can. And, I know that in North America, there are a lot of people who hate electric cars, and around the world, there are other people that hate the mandates and they don't like the electric cars being stuffed down their throat. But the reality is that the electric cars are not going away, and the adoption is increasing in other parts of the world. In China, I heard just recently that something like half of all the new cars sold are electric. And in green places like Norway, it's like they're going all electric. So even if you hate electric cars, you can't let that blind you to what's happening in the world. So this electric, and by the way, it's not just the cars. And then you also have the AI data centers. And even if you hate AI and you think it's all a big hype bubble, it's overblown, it's not like it's going away, or it's not like there's not going to be data centers or other massive uses of compute and electricity. Like there is something real there, even if it's not as big as imagined now, it's still there. So the demand case is, I think, very strong for you can argue about how quickly and how high it'll go up, but there's no case that it's going down, that we don't need no stinking copper anymore. Well, okay, there is a case. There's new technology for room temperature conductors that could replace copper in some uses, but that's not in commercial application yet. So that day may come. but that's a science project that I'm not betting on now. So the demand case is, in my view, extremely solid. And where I was starting to say the difference between oil and copper is that oil has a capacity to really flood the world with a lot more supply, whereas copper is supply constrained. Not only do we not have the discoveries happening and the future pipeline looks very dry, like just right now, despite the push in the United States, there just aren't that many shovel-ready projects because the permitting is so difficult. So like even if you made all the permitting problems go away in the United States, the shovels might hit the dirt on new projects like in 1 or 2 places. And only one of those is really big, right? The rest will take years, even with permitting tailwinds. And in the rest of the world, the permitting tailwinds are not really there yet. Yes, Europe has a few critical projects, and Canada's talking about, streamlining. But Canada's idea of streamlining is taking 10 years and turning it into 2 years of permitting. Sorry to my Canadian friends, but I think they know whereof I speak. What I'm saying is that the supply constraints in copper are not easily fixed. Even if all the governments of the world just got to be in their bonnet about critical minerals, we got to have copper, and they all decided to do like Trump and say, okay, you're going to issue permits in 2 weeks, which he said, but we haven't really seen yet. But let's say everybody did that. You're still looking at years for these big new copper mines that we need to come online. So, eventually maybe there's replacement. Eventually maybe, these big copper mines come online with permitting and so on. But now, what's happening now is increased demand with supply constrained. So the only reason why I haven't bought a lot more copper stocks, and I do have a couple, I didn't just completely sit on my hands, is because I'm concerned about near-term volatility, Trump shock. Again, even if you're completely on board with his agenda, the transformation that he's trying to in place, and we just saw this last week. Trump talked tariffs, copper fell off a small cliff, the stock markets too. I just don't think we're done with Trump shock yet. And that has me not worried about, but actually looking forward to a buying opportunity in the copper space probably before the end of this year. And I expect to go massively long. And if not, okay, I missed the bottom. I'll still buy. I still think I'll make a ton of money because I see a multi-year bull here, if not potentially a multi-decade bull in copper. Maybe it's not as exciting as gold and silver or even platinum, going crazy this year or whatever. But my confidence in this thesis and the high degree of conviction that I have of gains for years to come make copper, really, really exciting to me.
Those fundamentals do sound incredibly exciting. What about
I am a fundamentalist after all.
Well put. What about the cyclicality of copper? Dr. Copper, of course. I know that you're quite vocal about that the US might be in a recession or might be tipping into a recession. Could that negatively impact that long-term bullish case on copper?
No. Specifically, you said long-term. Near-term, yes. And that's I'm actually expecting that, which is why I haven't deployed my treasure chest, my war chest here. But I have been accumulating to put into the space. And as my upside maximizers are triggered on my big wins in the gold and silver space, I expect to put a lot of those winnings into copper because of this very thing you say. But it's okay. It fluctuates. Nothing goes in a straight line. That's nothing new. The long-term case that we're talking about is upwards to the right. And okay, let's say it goes up and down as it does that. Fine. That's great. You make that volatility your friend. If as long as the overall trend is heading upwards, you take some profits, you redeploy, you go up and down. This is why Doug Casey used to say that volatility can be the disciplined speculator's best friend.
Volatility is opportunity for someone who's value-oriented.
Precisely. And actually, that's a really good point. It might sound like, oh, I'm a speculator. That's just a gambler. Again, no. But it's not just the discipline. I think of myself, believe it or not, it sounds like a contradiction in terms, but I think of myself as a value speculator. So if I have a fundamental thesis about where the market is going and I see a company and there's an NPV or a NAV or whatever, and I see a discount there, and I'm bullish on the space, well, that becomes a candidate. The reason why there's no gold stocks on my shopping list right now is that I'm not seeing that discount. Okay, so, anyway, don't need to beat that to death. But yeah, I mean that, and if you're not, if you're willing to, I don't want to be pejorative here. Like, I need a compelling value proposition. I just won't speculate without a compelling value proposition. Can't kiss all the girls, and if it gets away, too bad. I'm okay with that. By betting on value, I make money more consistently, which doesn't mean that you can't gamble on other people, feeling the FOMO and jumping in. And so please hear me, audience. I'm not saying, you're stupid or you're wrong or whatever for jumping on this bandwagon and placing your bets. I'm just saying that's a gamble I'm not willing to take as a value speculator. And if you do and you make a bunch of money, great. Just don't forget to take profits.
All right. I would also love to hear your thesis for uranium.
Yeah, uranium is I feel like, again, we all say we're contrarians, but are we really? People get so pissed off when things go down. They only are happy when things go up. But I'm long uranium, and the thesis there is somewhat like copper, right? You've got supply constraints. Actually, last year, I think it was reasonable for people to say, oh, uranium hit triple digits. This is going to incent new supply. And high prices might cure high prices. It was at least reasonable to ask that or worry instead of just chasing, oh yeah, it's going from 100 to 200, woohoo, right? That turned out to be wrong, at least not right away. The people who were concerned turned out to be right, and I think that was reasonable. But what we've seen since then is that basically everybody who responded to those high prices to bring new production online has, if not failed, and some have just flat out failed, they've moved the goalpost or they've dialed back their ramp-up expectations. Even the two biggest and the best companies in the world have moved the goalpost on their uranium production. So what we're seeing is at the very least, what we're seeing is that high prices are taking time to cure high prices. And this is important because uranium is not actually rare. There's a lot of uranium around the world. But if the highest margin projects or the mothball production of existing producers that could most easily bring it back online is struggling, well, that tells me that the supply side in the uranium space will remain constrained. And that's very, very bullish because the demand side is going nuts. That's what everybody can see. China's doubling its reactor fleet. The United States is going, it's done a real about face on nuclear. Even Europe, right? I mean, in Japan, right? I mean, it would be hard to imagine a more bullish macro environment for uranium than what we see in the world. I mean, basically the nuclear renaissance has burst upon the scene in a big, big way. So you combine that with supply constraint, and I really, really like the space. My problem with uranium isn't the metal or the fundamentals of the market. My problem is that I think it's so obvious. What I've just said, everybody can see it, that the uranium stocks are not cheap. And as we were just discussing, I see myself as a value speculator. I want to buy something at a discount. And if I can't, I cross my arms and I wait. Therefore, the fact that uranium corrected significantly last week is pretty exciting to me. I'm hoping that I'll have another buying opportunity because I see this as not a forever bull. Like I'm longer term, I'm much more bullish on copper than uranium. But for the next couple of years, I'm very bullish on uranium. And absent not even a Fukushima, but I think it would take a Chernobyl scale event to derail this investment thesis. I'm that convinced about this. But I've already got uranium stocks, so I'm not feeling any FOMO. I'm waiting for the next fluctuation, and this market is fluctuating now. We'll see what happens this week. But there's sort of a trend line in the uranium recovery, and I know I'm not a technical analyst, but just, one line, forgive me for one line. If uranium corrects to that trend line and breaks below it, I could see that creating a buying opportunity. And if so, maybe some of this money that I've been accumulating, waiting for copper, maybe I'll put that into uranium just because the opportunity presents itself.
A fundamentalist that does employ technical analysis from time to time when it suits him.
Well, one line. I hope the audience can forgive me.
I'm sure they will. So what type of pullback are we talking about for you as a value speculator to be enticed to take up an even larger position in uranium?
I would, so it wouldn't be a magnitude thing. It would be how the narrative trades and what it has on the stocks. Like if uranium were to correct back down into the 60s, I think you would see some panic. I think you'd start to see people saying, oh, high prices are curing high prices. Oh, this rebound this year, it was a head fake, right? You start seeing some of that negativism come back. And that's what I think would create the buying opportunity in the stocks. Or more simply put, I'm not buying anything at a 52-week high or an all-time high. That's just not how I work. Even if I think it's going higher, I just can't bring myself to buy that peak. If it corrects meaningfully, a 5% correction in uranium could easily create a 20-25% correction in the uranium stocks. If that negativity set in. If that happened, I would probably be a buyer. I wouldn't need like this huge, like 50% washout or some kind of giant retracement. Absent a nuclear accident or something like that, I actually don't think that we won't see that big. I just said that it's that obvious that the bull case here is so obvious that the stocks have held up really well. So my idea of a meaningful entry point would be less aggressive. Like I could see copper stocks if there's Trump shock and we get this Dr. Copper responding to economic fear, terror in the broader markets. I could see copper dropping 10%, 15%, and the copper stocks dropping 30%, 40%, even 50% if people get really fearful. I don't think we'd see anything like that in uranium. It's different. Uranium is essential for baseload power, airports, hospitals, that kind of thing. The demand and supply are happening here and now. So yeah, maybe a 20-25% retreat in the share prices would get me interested. But I would still be looking at value. I'd still be looking at some kind of discount to whatever the valuation is.
Value speculator, even uranium, that's noted. Something that we've been seeing recently is, this trade war also in critical minerals. We saw it in antimony where China blocked its exports and that price spiked. We've seen it in tungsten. Is this something for you as a value speculator that's tradable, betting on these commodities to get an export ban and potentially get a nice upswing through that?
No. And again, hear me, I'm not saying they're not going higher. I'm not saying that these surges can't last. These oddball metals are small, opaque markets. So let's say antimony, take it just as an example. I mean, that could last a while. Antimony is not rare. There are, it co-occurs with a lot of gold deposits. So you got a lot of gold juniors that are now suddenly reporting antimony assays, and they're getting tailwinds in the marketplace. So if you had ignored the grumpy old wolf and had bet on antimony when this happened, you would have made money in these antimony plays. In most cases, you would have made money. Problem is, there's no telling when that train will go off the rails. I mean, you won't see it coming. There's no trend here. You can't say, oh, it'll go into this price, and then that high prices will cure high prices, and then it'll come down. It's not like that. A single big new mine that we didn't know about in Brazil or China, or no, not China. They're the ones doing the restrictions. Vietnam, I don't know. Someplace not China, right? A single big new mine could radically alter the supply side here, and you won't see it coming. It could be in private hands, and you won't see it until it actually happens. So what I'm saying is, as a disciplined, fundamental value speculator, these kinds of opportunities, I'm not saying they're not real, but they're not ones I tend to jump on, because there's no way to know how long it will last or how high it will go. Now again, if I'm more of a gambler or a day trader, yeah, I think those things are investable. Not invest is not the right word. They're tradable. Okay, but that's not my method. So just beware. If you go there, you never know how long it will last. And by the way, the easiest change that could just absolutely tank all these things is Trump and Xi kiss and make up tomorrow, announce some new deals, and all the restrictions go away. These prices would crater. Like, even if the United States says, okay, that's great, but we still want to build up some domestic supply, even if they provide subsidies right, to try to diversify supply chains, fine. But if China says, oh, we're friends now, you can have all the antimony you want, the price will tank and those stocks will absolutely crater and you won't know until after it happens. I'm not predicting that. I'm just saying this is why, no matter how exciting they are, I tend to watch these things from the sidelines.
Talking about oil and gas for a second, there's people, for example, Rick Rule, that are sharing now that this commodity or this commodity complex might be becoming hated now with oil trading at $60 a barrel, or at least in that range. Is that something that's on your radar?
No, because you've also got Doomberg saying that you need to think in terms of barrels of oil equivalent, not just oil. And, the whole peak oil thesis just goes out the window at that point. So which one's right? I don't know. What I do know is that OPEC is ramping up supply. There's still concerns. The thing about stagflation is, we haven't really talked about that, but my macro outlook is stagflationary. And the thing about stagflation is, well, the higher inflation can have people think, oh, the economy's hot. It's like it's doing better than we expected, which is why we have this inflation. But you're forgetting the stag part. So we could have higher prices in many things, even though the economy is weakening. And unlike uranium, which you need to keep your airports and hospitals going, right? 24/7 baseload power, oil has a lot of discretionary demand, right? You can decide, okay, we don't need to take a trip to visit grandma every weekend. We can go every other weekend, right? That sort of thing. So, yeah, I'm concerned about oil in the near term. Longer term, I'm concerned about the potential for the glut to just persist. Rick likes to make the argument not just that it's hated, but that the industry's been starved of capital, and that at some point that will make a difference. That's a reasonable thesis, but I'm not sure if that swamps the Doomberg thesis. I just don't know. Right? The honest answer is I don't know which of these things will be more powerful. If I had a strong opinion on that, I'd make bets one way or the other perhaps, but since I don't know, I'm on the sidelines. But at some point though, here's what will get me into the oil patch. Prices are rising. There's a real supply constraint. Like we thought this basin was going to deliver, it didn't, or I don't know, but prices are rising and the supply isn't there. Like OPEC implodes or something happens, I don't know. Maybe some large oil field in the Middle East turns into a large nuclear glass bowl. Something affects supply. I'm not saying I want that to happen, dear audience. That's not what I mean at all. I'm just saying, what I'm saying is, a la Rick Rule, I'm not going to bet on what's inevitable or even what I think is imminent. I'm going to bet on what's happening now. And if I see a trend of higher oil prices based on genuine supply constraints, that becomes investable to me. Before then, I don't want to hear your logic. I don't want to hear your historical, comparisons. Arguments won't persuade me, only facts. This will be an empirical decision, not a logical decision. I don't mean illogical. You know what I mean. It'll be based on the data. Oh my gosh, am I turning into the Fed? Am I data dependent? Well, I hope that just means that I'm paying attention to reality and not just theory.
I would love to hear your data-driven analysis behind that stagflationary thesis that might differ from the Fed that you just referenced.
Well, the relevant data that we can point to, other than anecdotal data, the broader theory is actually that we still haven't paid the piper for all the damage that was done from the COVID-19 lockdowns and whatnot. Mm-hmm. Like that was really bad news. And we are still feeling the consequences from that. And now on top of that, we have Trump shock, which again, even if you agree with Trump, you have to understand that what he's trying to do, this transformation cannot be done without any pain. So, and of course, if you disagree with them, then you think it's terrible. There's a lot more pain to come. So the data, that's the context. The data is that the labor market information, which somehow we just don't have this month, right, was showing great deterioration. The ADP print of negative 32,000 jobs was a shocker. And people are like, oh yeah, ADP is more volatile and blah, blah, blah. But A, it's private data, not government data. And even if it's volatile or even if it's inaccurate, it was still negative. And not only that, they revised the previous month down from $54,000 plus jobs to minus 3,000. And we have seen this deteriorating labor market. And by the way, and people say, oh, but the unemployment rate is still low. Well, that's another COVID hangover. You hear even on the mainstream people talking about this weird dichotomy in the labor market of no hire, no fire. Right? The no hire, that's economic weakness. Now, the no fire, you might say, oh, that's a sign of economic strength. Well, no, I don't think it is. I think that's the COVID hangover. Companies remember that how difficult it was to get employees in that time, and they're still reluctant to let people go in case they might need them. But the fact that they're not hiring, I think, cannot be overlooked. So there's part of the data that, from conventional points of view, suggests more strength in the labor market than I think is real. I think if you look at it in the lens of what happened to us, the labor market is much weaker than people appreciate. So that is the stag. And the inflation, you say, oh, well, it's way down from 9%. It's only around 3%. Well, 3% was enough to upset people in the 1970s. It's also 50% higher than the Fed's arbitrary target. Right? And it's going the wrong direction. For 4 months now, it's been going up. CPI, PCE, core, whatever, it's been going the wrong direction. So it's above target, and it's going the wrong direction, and the labor market is weakening. There's deflation, there's the stag. Palisade couldn't see either of them, and he's caught on the horns of both right now.
Thank you so much, Lobo. Please tell us about the Independent Speculator.
Well, very quickly, for the 3 people who didn't stop listening, independentspeculator.com, right over my head. We have a free weekly digest. It's absolutely free. We will not spam you if you sign up for it. And if you like the way I think, then you might consider hiring me as your due diligence guy through my paid services.
Lobo Tiggre, thank you so much for your generosity with your time and insights today. Truly, truly appreciate it.
Thank you, Stijn. We covered some important ground.
Definitely did. This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.